Hello everyone and welcome to the YouTube channel of Being ACCA. This is Tushita Gupta, ACCA affiliate, and in this video we're solving the last OT case study from your FM Pre-June mock exam. This is Karooba company. There are question number 26 to 30 which we have to answer with this case study. So reading the very first requirement to calculate the cost of equity, I can understand that this is a section B question being tested from the cost of capital unit. So let us read the information which is available. Firstly, I can see the balance sheet. Then the ordinary shares of Karooba company have a nominal value of 0.5 per share and a cum dividend market price of 5.75. A dividend of 55 cents per share is about to be paid. Dividends are expected to grow at 5% for the foreseeable future. Then you have information regarding irredeemable loan notes. Then there are some convertible loan notes, and then you have the tax rate given to you. So firstly, to calculate my cost of equity, it's very simple. I will use the dividend growth model. My market price, which is given to me, is 5.75, but this is a cum dividend price. So I need to subtract the 55 cents of dividend, which is just about to be paid. So this is the market price per share. And if you see, the growth rate is also given to you as 5%. All right, so 5% is the growth rate given to us for the dividend, and 5.2 is the ex-dividend market share price that we have calculated. So using the formula sheet, you have, all of the formulae given to you over here. We are currently trying to work out the cost of equity. So cost of equity is nothing but your D0. So dividend is 0.55. Let us do it with brackets. So 0.55 multiplied by 1 plus the growth rate. So 1 is 1 plus the growth rate, which is 5%. So 1.05. You divide this by your price, and the price, which is X dividend, is we have calculated to be 5.2. So this is your first part. And that's to this entire thing, you're adding the growth rate. So the growth rate is 5%. So your ultimate answer, let us convert it to a percentage format. So in percentage, you're getting an answer of 16.11. So because they want to one decimal place, you enter 16.1% over here. Moving to the next one. What is the cost of debt of the 7% loan note? So let's read the information that is provided. The 7% loan notes are irredeemable and have a nominal value of $100 per loan note. The current cum interest market value of the loan notes is given to you as 104.5. So this is the market value, which is cum interest. That means interest is already included in it. This is question number 27. So firstly, I need to find out my interest. So interest is nothing but the 7% of the nominal value, which is 100. So 7% of 100 gives you $7 as the interest. Now to convert it to post-tax, basically your post-tax interest is nothing but this figure multiplied by 1 minus tax rate. Tax rate is given as 28%. So with this, you have your post-tax interest also worked out. Now let us find out the market value. So market value of my loan note is nothing but 104.5 minus the interest, which is just about to be paid, of 7. So 97.5 essentially is my X interest market value. Now I just need to find out my cost of debt, which is there post-tax. So it's nothing but I divided by your market value. So I over here is 5.04. Divide this by your market value of 97.5 and you will have 5.17% as your answer. Moving ahead to the next one, you have to find out the market value of the 6% loan notes. So these loan notes are convertible after 4 years into 20 ordinary shares of 100 rupees, $100 loan note. If not converted, they will be redeemed at 10% premium. Before tax cost is 8%. Share prices are expected to grow 5% for the next 4 years. So what do we do over here? We need to find out the market value of these loan notes. This is question number 22. First, 28, my apologies. So firstly, I'm going to put over here year by year all of my inflows. So 2, 3, and these are redeemable after 4 years. So in the first year, what is the market value? Always remember, is going to be understood from the perspective of the investor. So you're not going to take the post-tax values over here. Firstly, you will take your interest, which is, applicable over here at the rate of 6%. So firstly, you will take the 6% interest. This is 666 every year. Now, in the last year, there will be interest plus the redemption value or the conversion value. Let us see which option is higher. Option 1 is either to take it at a 10% premium, which will be 110. Option 2 is to get converted to equity shares. How many shares? 20 equity shares. What will be the value of one share? Presently, the market value was 5.2, which we just calculated above, into 5.2 and multiply that by your growth rate. So 1.05 raised to the power of 4 years. So this over here is my conversion value. So either I have the option of getting 110 or I have the option of getting it converted at 126.41. So let's see over here. Obviously, if you compare your redemption value, all right, so any rational investor is going to choose option 2 over here. So in the last year, I'm going to get 6 plus the, the redemption value. So I will find out the NPV, the net present value of all of these cash flows. The rate that I'm going to be using is going to be the before tax cost of debt, which is 8%. Now, if you just take all of these figures from here, hit enter, you will arrive at your answer. You will see that the correct answer is not given over here. That is why, if you even go towards the marking scheme of this, this mock exam, it's going to show that they have taken 15 shares over here instead of 20. Although in the question they have given 20, but they have wrongly taken it 15 over there, which has led to a wrong calculation for them. Hence, this over here will be your correct answer. It's not there in the options. It's probably a mistake which has been made. So the correct way over here to calculate will be this way. You calculate both of the values. Either you get it redeemed at 110 or you get redeemed 20 ordinary shares. 5.2 is the ex-dividend price, and then you multiply that by the growth rate raised to the power of 4. So you have 126. Obviously, you're going to choose the second option. So it's going to be interest plus this value in the last year. And then you work out your NPV at the rate of 8%, which is the before tax cost of debt, and then select all of the values. This should be your final answer. Moving ahead, this is question number 29. Which two of the following are consistent with M&M with tax theory? So the first statement says the cost of equity is higher when there is a high proportion of debt capital. This is absolutely correct, because as in when you're increasing the proportion of debt, because the company gets more financially risky, hence the cost, because the equity shareholders need to be compensated for the increased risk that they are taking. So the cost of equity also rises. Let's move to the second statement. The value of the company remains unchanged with increased gearing. No, when the cost of capital is rising, then the value of the company will fall. The weighted average cost of capital falls with increased gearing. Now, this is absolutely correct. What happens is that when you are increasing your gearing, because in the beginning till the optimum level of debt, basically your cost of debt is lesser, and because of the tax benefit, you're getting capital at a lower cost. The debt is at a lower cost compared to equity. So initially, definitely your weighted average cost of capital definitely falls with your increased gearing, but till the point where you have reached the optimum level. After that, your WACC also eventually starts to increase. Then the last statement says there is a point at which the weighted average cost of capital is minimized. No, this is not correct. According to M&M with tax theory, basically, the with tax theory tells you to take as much debt as possible. Hence, there is no point where they think, that the WACC is minimized. So these two are the correct statements over here. Moving towards the very last question for this case study. Which of the following is consistent with the traditional theory of capital structure? So let's read the statements. The value of Karooba company with increased gearing until the optimal capital structure is reached. The value decreases. No, that is not correct. The weighted average cost of capital remains constant with increased gearing. No. So basically what happens over here is the traditional theory actually tells you that if you see the gearing that they currently have, if you compare it, basically the book value of your gearing, it's if you see debt to equity, you have a debt of 77, and if you compare it with your equity 375, you find that it is roughly around 20%. So debt divided by equity is only 20%. This means which is a low gearing. So this statement over here, Karooba company has a low gearing and should increase the debt to decrease its weighted average cost of capital. This statement is absolutely consistent with your traditional theory of capital structure. With this, we are done with this MCQ, and in the further videos to come, we will be solving the section C from the FM Pre-June mock. I hope that this was useful. Thank you for watching. I'll see you in the next